Due to accelerating inflation around the world, consternation has predominated in markets since the beginning of May. The global economic recovery is occurring quickly, but due to restrictions countries imposed during the pandemic, the manufacturing and logistics of supply chains have suffered. As a result, we are witnessing a rapid growth of prices of goods and raw materials. Lumber, copper, iron, produce, and many other goods have more than doubled in price. Thanks to the actions of central banks around the world, the market has been flooded with free money. Policies of near 0% interest rates and stimulus programs have revitalized deferred demand. The population is rapidly raising its demand for goods of various categories, but supply from producers is struggling to keep up. As a result, investors have begun thinking about an impending tightening of monetary policy, particularly by the U.S. Federal Reserve. A shift is occurring in markets from growth stocks, mostly in the tech sector, to value stocks. Stocks of companies that have been stable and sustainable businesses are popular among investors today. To avoid volatility in stocks, many prefer reliable companies with large dividends. Growing dividends from strong stocks is an ideal combination. Dividend aristocrats are stocks of large companies that have continuously paid out and increased dividends over 25 years. The key to dividend aristocrats lies in the presence of significant competitive advantages that attract customers to the company's products and services regardless of economic conditions. Occupying a dominant position in an industry allows companies to increase revenue and profit for long periods of time. The resultant growth, in turn, allows companies to return capital to shareholders as dividends. Dividend aristocrats have a strong business model and ability to offer goods and services that customers need, even during recessions. AbbVie is a pharmaceutical company specializing in immunology, oncology, and virology. AbbVie stocks can be found in the portfolio of Berkshire Hathaway's legendary investor Warren Buffett, as they are the optimal combination of profitability and financial stability. AbbVie boasts a strong product line of pharmaceuticals with a rapid rate of sales growth. The company plans to guarantee a moderate pace of profit growth by 2024, as well as robust growth within the decade. The company exceeds analysts' expectations of earnings per share, or EPS, every quarter. The April 30th, 2021 quarterly report predicts growth in EPS by 25.7% versus the same quarter last year. Profit has grown by 62.4% over 3 years. Quarter-on-quarter sales have grown by 59.2%. It is cheaper than the market and industry on the basis of fundamental multipliers. Forward PE is 8.03, PS 4.24, PFCF 21.4. Return on earnings totals 51.1%. Operational profitability equals 24.8%. The company's current annual dividends, totaling $5.20, have increased by 10.2% versus last year. AbbVie has raised its dividends 5 times in the last 5 years by an annualized 21.31% on average. AbbVie's dividend returns currently total approximately 4.5%. The company raised its dividends by a colossal 225% upon its separation from Abbott in 2013. The company has continuously raised dividends for 49 years. Procter & Gamble is one of the largest global companies and manufacturers of consumer goods. The company's product assortment satisfies a wide range of needs, from diapers to laundry detergent and toothpaste. Leading brands include Tide, Bounty, Gillette, and Pampers. Procter & Gamble has undergone a massive transformation over the past few years, with the company selling off less popular brands. Just a few years ago, the company had around 170 different brands, but since then the number has dropped to 65. This has allowed Procter & Gamble to focus on the most important brands. This sell-off helped lower expenses and raise profit margin. Consumers have also begun to trust the company's products and, as a result, are more than willing to pay higher prices. This pricing scheme also helps the company endure recessions. During the Great Recession, when many companies reported steep profit declines, Procter & Gamble's earnings per share rose almost 18%. Growth during recessions is one of many reasons Procter & Gamble has continuously raised dividends over 65 years. Annual dividend growth rates over the last decade have totaled just over 4%. Considering the reasonable payout coefficient and dominant position in the industry, P&G stocks should continue to raise dividends in the coming years. Federal Realty is one of the largest real estate investment funds in the U.S. The trust was founded in 1962 and competes in densely populated coastal U.S. markets with a high level of income, which allows it to charge more per square meter than its competitors. The funds from operations have not decreased on an annual basis once in the last decade, an impressive feat given that the U.S. economy was dealing with a crisis. Federal Realty signed 110 lease contracts consisting of 514,656 square feet of retail space in just the past quarter. The company likewise rented out 506,307 square feet at an average rate of $36.58 per square foot. That guarantees a growth of extension of 9% in terms of cash. 91.7% of its property portfolio has been leased out. As the Chief Executive Director, Donald K. Wood, states, "We have seen yet another quarter of high demand for leases by a large base of high-quality renters, with rental prices in Q1 2021 exceeding our average figures by 37% for Q1 in 10 years. Coca-Cola is the largest global brand of drinks, owning and holding licenses of over 500 unique non-alcoholic drinks. Since its founding in 1886, it has expanded to over 200 countries. Its brands make up around 2 billion drink units worldwide every day, generating over $36 billion in annual revenue. It also boasts 20 brands that generate at least $1 billion per year. Coca-Cola predominates among non-alcoholic carbonated drinks. The company is trying to maintain and even improve its dominant position by expanding products of its existing brands, including reduced sugar and sugar-free variants such as Sprite and Fanta. On April 19th, Coca-Cola reported a profit for the first quarter of 2021. The company has never once failed to increase dividends in the past 59 years. Home Depot is the largest global specialized retail chain of home products, which commands approximately 2,300 warehouse stores offering over 30,000 products in physical outlets, as well as over 1 million products online in the US, Canada, and Mexico. Home Depot benefits from a robust housing market and significant upgrades to its merchandising and distribution systems. The company's capital distribution has been used to raise shareholder value through dividend increases, stock buybacks, and capital investments. Home Depot derives solid competitive advantages from its size. It is an inexpensive supplier wielding significant leverage in negotiations with its own suppliers and sellers. The company invests in technologies that allow customers to connect to various platforms and staff members in order to more efficiently serve customers. Sales and profit grew by an annualized rate of 31% and 86% respectively in the first quarter of 2021. Sales in the US stores rose by 30% on an annual basis. Home Depot offers its investors an above-average monetary income. Moreover, Home Depot has increased its payouts since 2010 annually. Home Depot's dividend payout coefficient, or the net profit percentage of current year declared on dividend payouts, totals approximately 60.4%. Although this remains a serious burden, 39.6% of company profits remain accessible for payout hikes, stock buybacks, or investments in growth. Dividends appear more robust in terms of money. The company's free cash flow has totaled $12.2 billion over the past 4 years. Annual expenses of dividend payouts totaling $6.07 billion have left Home Depot with a large net surplus cash flow after deducting payouts. The company currently also has funds totaling $8.7 billion. Moreover, analysts predict that profit on the stock will rise by 4.2% on average per year over 5 years. Although that is regarded by most as a moderate growth pace, it doesn't hurt dividend stability. Consolidated Edison is a municipally owned corporation with a large capitalization. The company's annual income totals approximately $12 billion and its market capitalization totals around $25 billion. The company serves over 3 million consumers of electric energy and as 1 million consumers of gas in New York. It manages companies involved in the transfer of electric energy, gas, steam, and environmentally friendly energy. 2020 was a difficult year for Consolidated Edison. Q4 profit rose by 0.3% to $2.96 billion, falling below estimates by $190 million. The adjusted net profit totaled $253 million, or $0.75 per share, compared to an adjusted net profit of $288 million, or $0.87 per share last year. As the U.S. economy gradually improves and normal conditions return, the company will continue to post modest growth into 2021. Consolidated Edison guarantees a moderate growth in profit each year by attracting new clients and hiking rates. One of the advantages of working in a regulated industry is that utility companies may regularly hike their rates, which in essence guarantees a robust level of growth. Consolidated Edison's primary competitive advantage lies in large barriers to entry in the utilities industry. Gas and electricity are necessary and crucial to society. As a result, the industry is stringently regulated, which makes it impossible for new competitors to enter the market. This provides Consolidated Edison with plenty of certainty. Dividends have risen annually for 46 years in a row. Leggett & Platt is a prolific manufacturing company. It was founded in 1883 when investor J.P. Leggett created a bed spring that surpassed existing offerings at the time. Today, Leggett & Platt develop and produce a wide range of products, including bedding items as well as equipment to produce bedding items, steel wires that adjust beds, carpet cushions, and support systems for car seats. It develops and produces products used in many houses and automobiles. The company runs a diversified business both in terms of product assortment and geographical distribution. Leggett & Platt reported sales of $1.151 billion in the first quarter of 2021, 10% higher than in the first quarter of 2020. Leggett & Platt will rely on a versatile approach comprising acquisition, stock buybacks, and increasing efficiency through cost control. Leggett & Platt have a long-standing acquisition policy for smaller companies in order to expand its superiority in the market in current categories and branch out into new areas. Yet another key component of Leggett & Platt's strategy for profit growth is cost control. The company is constantly evaluating its portfolio to ensure it is investing in opportunities for maximum growth and is not afraid to sell off low-profit businesses with a low expected pace of growth. Leggett & Platt also has an extensive patent portfolio, which is of particular use for containing competition. Leggett & Platt boasts impressive intellectual property comprising approximately 1,500 issued patents and almost 1,000 registered trademarks. Leggett & Platt have increased and paid out dividends for 49 consecutive years. U.S. Federal Reserve officials continue to claim that the current jump in inflation is only a temporary phenomenon. As the global economy returns to normal, inflation will fall to target figures. They therefore are not planning any changes to monetary policy until 2023. Representatives of other global central banks have issued similar calming statements. At least for the time being, investors continue to trust these statements made by such high-ranking officials, in which they predict the situation will normalize by the end of the year. In this way, as global economies and inflationary expectations continue to stabilize, we will hold our capital in the stocks of reliable companies with strong fundamentals. That is, in the stocks that have endured multiple global crises and proven their reliability as dividend aristocrats.